What's up, everybody? My name is Joe Brown. This is Heresy Financial, and the Federal Reserve just concluded its December meeting. Powell gave a press conference, and so I'm going to go over the 5 things that you must know about what was said today about the future of monetary policy, because as we know, everything follows or is the opposite of what the Federal Reserve does now. Earnings don't matter, profits don't matter, cash flow doesn't matter, fundamentals don't matter. The only thing that matters is what the Fed does to the money. Make the money less valuable, everything goes up. Make the money more valuable, everything goes down. And so let's look at the 5 things. The first thing we're going to look at is how much they raised rates by 50 basis points and what that means. Number 2, Powell mentioned the cumulative effect of monetary policy and the lag of monetary policy. Number 3, when the Federal Reserve currently expects rates to top out and when they expect that they will pivot. Number 4, what the labor market is actually doing right now versus what the Fed thinks the labor market is doing. And then number 5, the reverse repo award rate update, and that changes things for when the Fed will have to pivot as well. So number 1, the Federal Reserve raised interest rates by 50 basis points. A basis point is 1% of 1%. So 50 bips means 0.5%. So this is the federal funds rate. This is like the base interest rate. And there's a range there, but they raised that range by 50 basis points, 0.5%. This means that monetary policy across the board gets a little bit tighter because that pushes up interest rates across the curve there. And so the last couple interest rate hikes that they've done has been 75 basis points, which were very aggressive in terms of the Fed's history. And so 50 basis points shows that they're slowing down on how fast they're tightening. It's like a car. Instead of accelerating, you're still moving forward, but you're accelerating at a slower pace. And so that's what they're doing right now. They've raised by 50 basis points. And that is still fast considering how much they've raised interest rates by so far this year. One of the fastest that they've done in modern monetary history. So number 2, the reason why it looks like they're slowing down is because Federal Reserve Chairman Powell said that they're monitoring the cumulative effect and the lag of monetary policy. So he's saying, hey, look, we're lifting rates by 0.5% right now, but that's not the only thing that's going on right now. The economy is still feeling the impact of all of the prior rate increases that we've done. It takes a while for those kind of things to hit the broader economy. Markets respond immediately. The broader economy takes time for those effects to work their way through. So he's saying we're slowing down right now to start to judge the effects of those that in the past have taken like 18, 24 months. But this is something Daniel DiMartino Booth pointed out recently, that yes, monetary policy a lot of times has a lag of like 1.5 to 2 years. But when the Federal Reserve operates at a severe, at a much greater degree than what they've done in the past, then it tends to hit the economy a little bit faster. So when they increase or when they lower rates and print a bunch of money to the tune of $3 trillion, like they've never done that before, that's going to hit the economy a lot faster than the QE that they were doing before. So now that they're raising interest rates at a faster pace than they've done in recent history, that is also going to hit the economy faster than prior interest rate hikes. Number 3, Powell mentioned that he expects that rates are going to top out next year, but not decrease next year. So traders and bets right now, they're looking at about 5 to 5.25% for the Fed funds rate to top out at next year. And that's when they expect the Fed to stop raising rates and just hold the Fed funds rate there at a little over 5%. Powell said, no, that doesn't mean that we're going to start lowering rates. In fact, he specifically said we'll probably lower rates to about 4% come 2024. So he said that he thinks it'll probably take a very long time for the inflation rate to come back down to a point where they feel comfortable lowering rates again. If you've been following this channel, I severely disagree with that. I think we're going to see the inflation rate tumble down come February, maybe March of this coming year in 2023, that we could see the inflation rate easily hit 2% by then because of monetary policy's effect on the total money supply and how long it takes the money supply to impact prices. And so Verdict is still out on that. We'll see if I have to eat my words on that, but that is my judgment at this point, which means I think the pivot will be able to come sooner because inflation will get back down to where the Federal Reserve wants it. Now, I don't think that the pivot is a good thing, by the way. I'm just saying this is what I think will happen, so I don't think they should pivot. I just think that they will. Number 4, labor market. There's an update. You can look on my Twitter profile. It was one of my most recent tweets. The Federal Reserve just looked at a report for quarter 2 of 2022 and found that in reality, payrolls probably increased by 10,000 jobs when the real reported number was 1 million. So that basically, like, the difference between 10,000 and 1 million is almost, 100%. And so basically no job growth. And this is another reason why I think we're going to experience an economic recession, crash, tumbling down here that's going to result in inflation crashing down because the jobs that the Fed thinks are there are not actually there. And then number 5, reverse repo market. So the reverse repo market, if you've been following, I've been monitoring that for a while. It's basically where banks have their excess cash. They park it at the reverse repo facility with the Fed in order to get the collateral that they need. So banks could go out onto the open market and buy T-bills and buy treasuries, but then there's risk associated with that. So they park the cash with the Fed in the reverse repo facility. They get the collateral they need, and they're getting paid 4.3% now because the Fed just raised the reverse repo rate. So 4.3% completely, absolutely risk-free because they're getting paid by the one who has the monopoly on money printing. So they're just going to keep on parking that there. So at this point, the Federal Reserve does not want to let go of that liquidity. They don't want that liquidity injection into the market. So at some point soon, it's possible we get into a liquidity crunch here where the Federal Reserve recognizes, hey, we need to send more cash out into the system because we're still going to be bleeding off our balance sheet. We're still going to be raising rates. So we need some sort of injection. That's when they'll lower the reverse repo facility award rate from 4.3% where it's at right now to a low enough rate where the market will just decide, hey, it's worth it now to go get some risk because, the return will be greater than what we can get from the Fed. That's not happening yet. We don't have a liquidity issue in U.S. banks as of right now. And that's evidenced by the fact that the Federal Reserve is keeping that $2 trillion in the reverse repo facility. And it doesn't matter if there's, like over the last month or so, we've seen a little bit of a drop down in the reverse repo facility, but that's probably going to completely reverse itself. It's already started to reverse itself somewhat, but it's probably going to completely go away simply because as we get closer and closer to these inflation numbers coming down and the Fed keeps on raising rates, the market starts to expect in the future the Fed will have to lower rates, which means that the market rates for things like T-bills and treasuries will start to drop in anticipation of that, which means that the reverse repo facility award rate will become more and more attractive, not less and less attractive. So until the Fed forces that money out of there, I expect that $2 trillion plus to just sit in there as kind of a secret weapon sitting on the Fed's, that most people don't know about it, that secret weapon there that they can pull it out and use at any time. And they're not using that yet because we don't have liquidity issues quite yet. So that is what you need to know, those 5 things. 50 bips raise in the Fed funds rate, which is less than the last few times, but still pretty aggressive considering their history. Number 2, they're starting to watch the lag effect of monetary policy, and it's all going to start crashing in very soon here, in my opinion. Number 3, they think that rates will top out next year, and then they'll start lower rates the year after that. I think it's going to happen much quicker than that because inflation will probably come back down quicker than that as well. Number 4, the labor market is not what they think it is. 10,000 jobs added in quarter 2. Not the 1 million that was reported. And then number 5, the reverse repo facility will be used as a pre-stimulus before they do a full pivot and go back to QE, but that is not coming yet. And they will keep raising the rate on the reverse repo facility until they need that money to go back out into the open market, those $2 trillion. As always, really appreciate you guys. Thank you so much for watching. Have a great day.